everyone. Today, we will explain how external monetary tightening and internal economy factors influence Bank Negara Malaysia's current monetary policy stance. Monetary policy refers to action by a central bank to manage inflation, growth, and financial stability. In Malaysia, Bank Negara Malaysia, or BNM, uses the overnight policy rate, which is OPR, as its main tool. In recent years, major central banks like the U.S. Federal Reserve has raised interest rates aggressively. According to the Federal Reserve, the Fed funds rate rose from near zero to over 5% during the tightening cycle. Yet, BNM has kept the OPR relatively stable. BNM's monetary policy commit maintained the OPR at 3% in May 2025 and later adjusted to 2.75% in July 2025, still among the most stable in the region, which from the sources of BNM official statement. This raises the question, why does BNM maintain a stable OPR while other countries keep rising rates? To answer this question, we must look at two sets of forces. External tightening pushes BNM toward rising rates, but internal forces, especially high household debt and the nature of domestic inflation, pull BNM back. The final stance is a balance between this pressure.
First, let's examine external monetary tightening, mainly the U.S. Federal Reserve's rate hikes. When the Fed raises rates, U.S. dollar assets become more attractive to global investors. As a result, capital tends to flow out from emerging markets like Malaysia into the United States. This creates three effects that pressure BNM. 1. Ringgit depreciation. Capital outflows reduce demand for ringgit. For example, data from the U.S. Federal Reserve show that the ringgit weakened to a high of 4.76 against the US dollar in February. External tightening puts persistent downward pressure on the currency. 2. Import inflation. A weaker ringgit makes imported food, fuel, machinery, and raw materials more expensive. This higher cost pass through to domestic prices. 3. Investor confidence. If a central bank falls too far behind the Fed, investors may lose confidence, triggering further outflows. In theory, to counter these pressures, BNM should raise OPR. A higher OPR would support the ringgit, reduce imported inflation, and keep Malaysia attractive to foreign capital. So, external tightening creates a clear upward pressure on Malaysia interest rates. However, BNM has not followed this pace. Why? Because internal factors argue strongly against hiking rates.
The first major internal factor is household debt. Malaysia has one of the highest household debt levels in Asia. Household debt reached approximately 1.65 trillion ringgit by March 2025, equivalent to 84.3% of GDP. A large part of this is housing loans, many of which are on floating interest rates. Here is how this influences BNM's stance. If BNM raises the OPR aggressively, borrowing costs for households will rise immediately. For example, a 500,000 ringgit 25-year housing loan, a 0.25% OPR hike adds about 70 to 80 ringgit to monthly payments. And in car loans and personal loans, a typical family could pay 200 ringgit or more extra each month. As monthly commitments rise, disposable income falls. Households will cut spending on goods and services since private consumption makes up about 60% of Malaysia's GDP. A spending slowdown would directly harm economic growth, possibly leading to a recession. Worse, some over-leveraged households may face default risk. Raising bad loans could hurt banks and threaten financial stability. Therefore, BNM sees a clear cost of raising rates, hurting millions of households, crashing consumption, and endangering the financial system. This cost is so large that it overweights the benefit of defending the ringgit. In short, high household debt acts as a powerful anchor that prevents BNM from following the Fed's tightening.
The second internal factor is domestic inflation. Many people assume that higher inflation always requires higher interest rates. However, this depends on the source of inflation. Economists distinguish between demand pull inflation and cost push inflation. While higher interest rates can reduce demand pull inflation, they are much less effective against cost push inflation. Malaysia's recent inflation has been mainly cost push. driven by higher food, logistics, and imported feed costs. At the same time, inflation remains relatively low, averaging 1.4% in 2025 and projected to remain between 1.5% and 2.5% in 2026. If B&M raises OPR, business borrowing costs will increase. Producers may reduce investments and output, leading to lower supply and potential even higher prices. Therefore, because Malaysia's inflation is largely cost-driven and remains manageable, B&M sees little need for aggressive rate hikes. Instead, targeted subsidies and supply-side measures are more effective solutions.
Now, let's put everything together. How do external and internal factors influence B&M's current stance? External monetary tightening Fed rate hikes puts upward pressure on Malaysia's OPR. It caused ringgit depreciation. For example, to 40.70 in early 2024, imported inflation and capital outflow, rates that would normally force a central bank to raise rates. Internal factors push in the opposite direction. High household debt, 84% of GDP, B&M data, makes rate hikes extremely costly. Meanwhile, domestic inflation is largely cost-push and manageable, only 1.4% in 2025, so raising rates would be ineffective and potentially harmful.
Faced with these two opposing forces, B&M's current policy stance is wait and see, maintaining a stable OPR at around 2.75%. It chooses to protect household balance sheets in the domestic demand rather than blindly follow the Fed's tightening. This does not mean B&M will never act. If the ringgit collapses sharply or if domestic demand suddenly overheats, B&M may adjust. But for now, the balance of pressures lead to a stable monetary policy. This explains why Malaysia has kept its OPR stable while major central banks continue tightening.